Thanks for joining us once again. You are welcome back to this session. So in this video, I'm looking from question 11 to question 20. So if you missed our previous video, the links are in the description section of this video. Try to check them out after going through with this presentation or this video. So without wasting my time, let's move on to our question. So question 11. Company B has irredeemable loan note currently trading at 50 Ghana cedis as interest. The coupon rate is 5%. And the rate of corporation tax is what? 20%. What is the cost of that? So before a business can finance its operation, you first of all will look at the cost that they will incur using that source of finance. That is the objective. They will consider the cost that they will incur using that source of finance. If the cost is far lesser than the return is going to end, fine, to go for it. If the cost is two-way higher than the return, then it will make a better decision. So with the cost of debt, it helps business people to make decision on what source of finance they will use to finance the operations of their business. So this is a debt for finance. Actually, we have two types of finance. We have the debt finance and we have equity finance. So irredeemable loan note is a debt finance. So let's see the cost from this information given. Now, to calculate the cost of debt, the coupon rate is going to be an interest before tax. Okay, but for us to know the actual cost of debt, it is the interest rate after tax. Is the interest rate after tax. So in this case, to find the cost of debt from this information, the cost of debt is going to be what? KDAT, meaning that cost of debt after tax is going to be the interest, that's the coupon rate, okay, into bracket 1 minus T, which is a corporation tax, and then divided by your price for that loan note, which is irredeemable loan note. S interest means there is no future dividend being added to it. Is that okay? So that is why you have the S interest. If you have it was to be price, mean that they have added the future dividend, but this one is X, so there is no dividend attached or added to the price here. So in this case, you just use this formula and to work it out. So here we know our interest to be the coupon rate of what? 5%. So it's going to be what? 5. Is that okay? So 5%, 5. Then 1, I know the corporation tax rate is what? 20% is going to be 0. What? 2. Is that okay? And divided by, I know the price here is for 50. Remember, securities are issued in denomination of 100 blocks. Securities are issued in denominations of 100 blocks. So if it is 50, it means that it's 50 out of 100. Likewise, the 5% for the coupon rate. That's why I also didn't bring the 100. Meaning that here is 5. Here is 5%. Okay. And here is also 50 out of 100. Here is 5 out of 100. Here is 5 out of 100, and here is also what? 50 out of 100. So you can write them in this form. So at the end of the day, when you compute for this, you should be able to get, you're going to get 2 out of what? 25. Okay, but then always cost of debt is always expressed in percentage form. So you multiply by what? 100%. So whatever you should get, you should be able to get around 8 point. So 8%, sorry. So let's say 8%. So 8% here, our options, option A will satisfy our answer in that case. So that's what? 8%. I hope that is clear. So that is the cost of debt for irredeemable loan note, which was traded at 50 Ghana cedi as interest. So let's take note of that. So this is how we calculate it. The cost. So the cost is going to be, is the cost to the business if you are to use irredeemable loan note to finance the operation as a source of finance to their operation, and becomes a return to the finance providers, that is the investors who actually invest in this source of finance to help the business to engage in their business, within the corporation. So that is the cost of debt after tax. So let's take note of that. Now let's move on to question 12. Question 12. Which of the following is not a way that a firm can increase a dividend? So There are a lot of ways that a firm can increase its debt. It has actually 3 or so. A firm can increase its debt by first increasing a dividend payout ratio. Dividend payout what ratio or payout ratio or rate. Payout ratio or what or rate. So dividend payout ratio here simply means we try to consider the dividend we're going to pay for a particular period of what period, taking into account the profit that we earn for that period. So the higher the dividend means that the higher you should be able to earn for that year. I mean the earnings. So dividend payout ratio means if we are to increase dividend payout ratio, meaning that we are paying out more dividend and keeping less of our earnings that we earn for a particular period. So that is one way of what increasing dividend. The other way of also doing so is by also increasing our earnings. So if we are to increase our earnings, mean that we earn more profit. Once you earn more profit, then shareholders are going to be paid more of what dividends, and there will be low retention ratio for the money that we should retain in a business. Then also by also decreasing our outstanding shares too can also be a way of what increase. So once we are decreasing our outstanding shares, we will try to reduce the number of shareholders who will be part of the business. So if we have little or few shareholders, let me use the word few shareholders within the business, meaning that if you earn huge profits, these few shareholders going to be those who are going to be paying what higher dividends as compared to a large number of what shareholders, which might cause what dilution to dividend and diluting of what shares in that case. So let's say, but here the options here, that is not part of the way that we can increase firm dividend, is by increasing with retention rate. So if you increase retention, meaning that you are paying less dividend and you are retaining more of what your earnings after every interest and expense. So the option which is not part of the way the firm can increase a dividend is what by increasing its retention. If you are to increase your retention, it means that your dividend is going to be less for a particular period of time. So let's take note of that. So all these 3 are parameters that we can use to increase what firm dividend payout ratio. Let's put it that way. So you can keep this in mind. If you are to meet it in the theory, they will ask you state 3 ways upon which a business can increase its dividend. You tell us that by first increasing its share outstanding, by increasing its earnings, and also by increasing its dividend payout ratio or rate. These 3 will satisfy you if you are to meet this kind of question. So let's take note of that. So by increasing its retention rate is not bad. So if you are really enjoying this video, please smash the like button and make sure to subscribe to the channel and turn on the notification bell, so at any time we release any new video, you'll be the first person to get it right away. So let's continue. Now let's move on to question 13. We have to use the information to answer question 13 and 14. So use the following information to answer question 13 and 14 below. Now let's consider the scenario here. Amankwa Manufacturing Company Limited has a current stock price of 30 Ghana cedi share. Is expected to pay dividend of 1.2 Ghana cedi in 1 year, and its expected price after paying that dividend is going to be what 33 Ghana cedi. So all that they mean here is that Amankwa Manufacturing Company is a company actually that they have a current stock price of 30 Ghana cedi per share, and is expecting to pay dividends of 1.2 Ghana cedi in 1 year. And the goal here is that after they paying 1.2 in 1 year, it is expected that the price of the share will increase from 30 to what 33. So what is that increase? What is that sharp increase from 30 to 33? This increase, we call it an increase in what appreciation of for the stock in terms of the price. So when the market price of stock increases, there is also an increase in that. There is also a returns increase. We call it what capital gains or capital gain yield. We can call it capital gains, right? So when stock appreciates or when stock increase above its par value or the face value, we call it what an appreciation or capital gains in that stock. So let's take note of that. At any time stock increases above its market price, or at any time any investment stock increase above its market price, we call it capital gains. Any extra amount that arise after comparing the original amount, the original price, and then the after increased price, the difference is called what? Capital gains. Capital gains. So let's take note of. So it's also part of what? An interest going to earn from that investment procedure, together with the dividend going to earn for that year. So that is that. So we have a dividend of 1.2, and also have what? Capital gains of what? 3 Ghana cedis from this scenario. So here, let's see the question actually. The expected dividend yield of Amankwa Manufacturing Company is, so we are asking us to calculate the expected dividend yield. So dividend yield, all right, as for dy, dividend yield by formula is equal to the annual dividend per share divided by the market price of the stock per share. Market price of the stock per share. So in this case, it's going to be, so that's the annual dividend in this case was what? 1.2 Ghana cedi divided. So what is also our current stock price was what? 30 Ghana cedis. But we always express in percentage. You also multiply by what? 100. So here you multiply by what? 100. Is that okay? So in this case, you expect that your 0 here will cancel out this 0, right? Is that okay? So with the help of a calculator, you should be able to get something around where 4%. Let's see whether that is true. For my case, I have 4%. So I got 4% as my answer. So that becomes what? Option what? C. I hope that is so. That is the formula for us to calculate expected dividend yield. It is the annual dividend per share divided by the market price or the current stock price of that share per share. Is that okay? Multiply by 100. If you want to explain the percentage, that's how it's going to be. Now let's move on to question 14. They also asking us to calculate Amankwa's expected capital gains yield. This was what I was talking about. When you're talking about capital gains yield, you are talking about an appreciation or a sharp increase in the current stock price let's put it that way, in the current stock price or a security or an investment that you made. So if there is an appreciation in the investment that you have made, whether a stock bond or any security, when there is an increase above its face or nominal value, any extra amount that you earn from that sharp increase called what? Capital gains. So capital gains here, for us to calculate capital, so I always call it a CGY. Capital gains yield is going to be the difference between the original stock price, compare with, the difference, we are comparison of what? The original stock price and then the appreciated what price from that stock. Is that okay? The difference between the two. So it's going to be the amount which has been what? Appreciated from that stock compared with the original what? Stock price, which is 30, okay, and then divided by the same market what? The market price per share. In this case, the original what? Price that we are talking about. The original price or the current stock, and then multiply by what? So in this case, I was using numbers here, so let me erase this. Come in. So as I'm saying, it is the appreciated what? Stock price compared with the original price was 30, and then divided by the same original price, which is what? 30 Ghana cedis, and then multiply by what? 100. So at the end of the day, you should be able to get, so with my calculator, I had 10%. So let's see whether you also get the same thing. So this is also how we calculate for, so this is what option D is also how we calculate for the expected capital gains yield. It is actually the comparison of what? The appreciation of for that stock price per share compared with the original price of that stock, okay, and then divided by the current stock price. In this case was 30, and then multiply by 100%, and you get in terms of percentage. So it is always the appreciated amount in terms of the stock price per share compared with the original or current stock price per share. The difference between the two, and after that you also divide by the current stock price for that stock, and then you express as percentage, and you are good to go. So let's take note of that. So now question 15. Current ratio is calculated as, so for us to calculate current ratio, it is one aspect of ratio of liquidity. When it comes to financial statement analysis, current ratio is one of the ratios that we use to assess the financial strength and weaknesses of what the organization through their income statement and the statement of financial position. So current ratio, as I call it as CR, it is always measured as what current what asset compared with our current what liability, and expressed as what, as 1. Is that okay? So current asset over current liability is to what, 1. So that is the ratio in that. So here it measures liquidity, the rate at which we can convert our assets into cash quickly. The rate at which we can convert our assets to cash what quickly. So the rate at which $1 of our assets can pay all our liabilities in terms of what current terms. So that's what current ratio deals with them in that case. So in this case, it's what current assets compared with current liability. So it's what option what A. So let's take note of that. Let's move on to question 16. Gerald invested $6,200 in an account that pays 5% simple interest. Take note of this, simple interest. How much money will he have at the end of 10 years? So for us to determine the amount that you're going to have at the end of 10 years is going to be, so here we know that present value of Gerald's amount that he has invested was 6,000, or the principal was 6,200, and it pays an interest of what? Interest or rate of 5%. Is that okay? Which is a simple interest. Is that okay? And then we are told that the number of years that you're going to have, the total sum of money is was 10 years. So time is what, 10 years. Time is 10 years. So in this case, for us to determine how much money will he have at the end of 10 years, it is going to be, so that becomes the future what value, or the total amount, which is going to be the present value plus the interest. In this case, what, a simple what, interest. So it's going to be 6,200 plus, so how do you calculate the simple interest? In this case, it's going to be your present value, which is the principal, multiplied by the interest, which is what, 5%, okay, multiplied by your time, which is what, 10 years in this case. So at the end of the day, we expect that here should be 6,200 plus, so 6,200 multiplied by 5% multiplied by 10 should fetch you around where 3,100. Help me with your calculation and let's see whether I get the same thing in that case. So in this case, for my case, when I add the 2, I'm going to get what, $9,300 what dollars. So that becomes how much money that will end, how much money you earn, Gerald will earn, sorry, if he invested 6,200 in an account that pays 5% simple interest for 10 years. So it's going to be 9,300 together with the present value or the principal and then the interest in that case. So let's take note of that. So this is how we actually undertake this activity. I hope you are enjoying. If you're really enjoying this video, please smash the like button, okay, and help share this video to your friends in everywhere so that they can also get a benefit to learn on this channel. That's what I use. YouTube also push the video to others also to learn. So try to subscribe and smash the like button and comment. Let me know whether you're getting things right or not, so that I will know what to do in the next time, and then to also to do things better for you to appreciate the content they are bringing very well. So in this case, the option or the correct answer is what, B, which is what, 9,300. So let's take note of that. Let's move on to question 17. Supposing Samsung Limited had the following information on its statement of financial position: current assets 68,937. Current liabilities 123,193. Sorry, and inventories 45,108. Determine the quick ratio for the firm. So quick ratio 2 is also a liquidity ratio that help us to quickly convert our assets to cash so that we can settle for any debt that we are due. So quick ratio 2 measures current assets taking away or taking into account your stock, and in other books you might also see what we call prepaid what expenses, prepaid expenses. Okay, so current assets minus stock minus prepaid expenses, and then divide by what your current liability, expressed as what a ratio of what 1. Is that okay? So that is the current stock. So the reason why when it comes to quick ratio we subtract stock and prepaid expenses here is that stock and prepaid expenses are very bit difficult to convert them into cash. For you to convert them into cash, it will take a longer period of time, but it's not certain for all organizations. We have certain organizations who can easily convert their stocks and other prepaid expenses into cash quickly, but then it's not general for all. In general terms, we are saying that stocks and prepaid expenses are more illiquid to convert them into cash quickly. So we always take it from the current assets value and compare with the current liability and express as what 1. The reason why we do that here is that with the rest that we are left with as part of the current assets in terms of the item, they are those that we can easily convert them into what cash quickly, like cash and cash equivalent, like marketable securities, like treasury bills and those stuff. They can be easily converted into cash. But stocks and prepaid expenses, as I've already defined, it is dependent on your organization. We have some organizations they can easily convert them into what cash, but then in general terms it is not easy. It is illiquid to convert them into what cash what quickly if the organization hasn't gone to certain level to actually deal with this stock in terms of conversion to what cash. So that makes it a clear difference between the current ratio and then quick ratio. With a quick ratio, we take into account the illiquid what assets like stock and then prepaid expenses, and then we take into account your account receivables, your cash and cash equivalent, other marketable securities like treasury bills and those stuff. So let's take note time, bill of exchange and those stuff. They are all assets that can be easily converted into what cash quickly. So let's take note of that. So in this case, our quick ratio, and as I've already defined, if you have a quick ratio of what 1, meaning that you have $1 amount or one currency, depending on the currency amount that you can easily pay or to settle your current what debt. If you have to convert it, if you have a quick ratio of 1 and above, meaning that you are highly possible that you can easily pay your debt as and when this is what is due. But if you have a quick ratio which is less than 1, meaning that you are illiquid, you can't pay all your debt because your quick ratio is what less than what 1. Is that okay? So mean that you can pay some but not all. That makes what a clear difference when it comes to way of this method of or this ratio of analyzing financial statement to know the strength and weakness of the organization. So in this case, let's see. From there we make analysis. So in this case here, quick ratio, our current asset here is what 68,937 minus all our stock or inventories was what 45,108. There wasn't any prepaid expense, so we just leave it like that. Divide by our current liability, which is what 123,935, and express as what 1. So with my calculator, I had my quick ratio to be equal to, based on the options here, they converted to decimal place, so I had mine to be 0.19:1. So mean that here Samsung Company Limited has a less chance of paying its debt because of what the ratio that is having here, comparing assets as against what like the rate as we can convert it assets to cash quickly to settle off the debt is far more lesser. So you can pay just few part of it debt and it will be left over. So in this case, as an investor, if you want to invest in this company, meaning that the rate at which you can get your cash or you can get your money that you invested within that company is not highly possible, looking at their ratio factor here, which is what 0.19. It's not even close to 0.5, half of one. No. So here, if you're an investor, you wouldn't think of investing in Samsung Limited company, because their quick ratio is far less than 1, and so therefore they become illiquid as and when investors will need their money to do other stuffs in that case. So that is the actual interpretation when it comes to quick ratio. So, but it's not enough. We have other factors that we also analyze into determine the strength and weakness of an organization in terms of others. So we have profitability, we have activity, we have also investment and those stuff. But then here I'm just analyzing from the liquidity position, the rate that we can convert our assets into cash quickly. So that's all about liquidity. So with quick ratio, it'll help us to know whether the business can pay debt as and when due or not, and it helps investors to make better decisions in that case. So let's take note of that. So here it is 0.19 is towards 1 in that case. So let's take. So if you are really enjoying this video, please smash the like button, okay, and share this video, comment as well, and let me see your responses in that case. Please like this video. The like is very important to me. Please like this video, okay, so we can get more engagement and assistance on this video. So let's move on to question 18. But one of the following is a model used to compute cost of equity. So since for when it comes to computation of cost of equity, we have 3 methods. We have what we call the capital asset pricing model, that is the CAMP. We also have the dividend discounted model. You have dividend discounted model, and upon which you have a dividend valuation model as one type of it. And you also have other premium price method of. There's also another way of calculating. You have 3 methods actually. So you have the CAMP here, and we have the dividend discount model, in which we have dividend valuation model as part of it. So in this case, since the dividend valuation model and then since dividend valuation model is an integral part of dividend discount model, we will go for the one with the sub here, which is for the capital asset pricing model, as a way of computing. But if there wasn't any capital asset pricing model, we should have gone for dividend valuation model, because it's a type of it's one type of dividend discount model that we use to estimate the cost of equity within the business. As I've already said, for a business to finance operation, is first of all look at the cost they're going to incur from using that source of finance in its operation. So that's why we always need to calculate to know whether it can help us for us to incur that cost, so that we can still stay within the business and have a healthy business activity or not. So these are the things that we take note of that. So let's take note of that in that case. So here our answer should be capital asset pricing model. Let's take note of that. Now let's move on to question 19. The principal participants in the financial markets are, so we have business banks, and these are not part. They are sub. We have borrowers, savers, and financial institutions, mutual funds, hedge funds, investment bankers. We have the dealers, brokers, and so here the main principal participants in the financial markets are borrowers, savers, and financial institutions. So borrowers, you individuals, that's households, business, and government. We are all borrowers. When it comes to savers, to the same thing: individuals, government, and business. You are also savers. Financial institutions to the business people that assist, or the medium that assist in the facilitating of the flow of funds from savers to borrowers, or it's a medium that exists to facilitate the flow of funds here from savers to borrowers. So that's financial institutions like banks, insurance companies, other companies. I mean, these are what we call the financial institutions. They assist in facilitating the flow of funds from savers to borrowers, or from borrowers to savers, any other way around that you want to indicate. So they are the main participants in the financial market. Let's take borrowers, savers, and financial institutions. Now 20. Joyce Anima has $125 now. How much will she have after 8 years if she invested it at 8.5% per annum? So in this case, since the question didn't make any method of computing for the interest, the idea is that based on the scenario, the idea is that it's being compounded annually. It's being compounded annually. So in this case, it's going to be our future value is going to be our present value multiplied by our future value factor, which is 1 plus the interest. Okay. And then to the power of the compounding period is 1 multiplied by the time. So I know my present value to be what? 125. Is that okay? Then I know my interest is what? 8.5% divided by my compound, which is what? 1 per annum, 1. And 1 here, 1 here multiplied by the time is what? 8 years. So here, with the help of a calculator, you should be able to get and look at the options here. We are converted to decimal place. So in my case, I had $240.08. That's what I got. You can also check with your calculator and let's see whether you also had the same thing. So since we're being told of the method of computing for the interest, the idea is that looking at the scenario, it is being compounded annually. So we're going to use compounding method of determine the whole amount going to be Joy is going to have in his account for 8 years with a present value of 125 in that case. So this is where we bring our video to an end. So if this video was really helpful to you, please go ahead to smash the like button, subscribe and share, and turn notification bell. Once we release any new video, you'll be the best person to get it right away. Make sure to like this video before you leave this video and share with your friends and everyone. So I will see you in the next video. We will continue with question 21 to 30 and discuss more past questions to assist you to pass your examination and to pass it well. And these tutorials or this MCQ I'm solving is coming from University of Professional Studies located in Accra, Ghana here. So if you're really enjoying, make sure to smash the like button and share. So I will see you in the next video where we discuss other matters in relation to that. Bye bye.